Welcome back to the boardroom. In our previous sessions, we shifted your mindset from a gambler to a CEO. We wrote a business plan that serves as your constitution. Now we face a structural question. Most people trade as sole proprietors. They use their personal bank accounts, pay personal income tax rates, and carry personal liability. But look at the wealthy. Look at the super rich. They rarely own anything in their own names. They control everything, but own nothing. They use entities. They use corporations. Today, we ask the big question: is it time for you, Inc., to become a real, legal entity? We are going to explore the pros and cons of establishing a personal investment corporation. This is not just about saving taxes. It is about building a legacy. But be warned, it is not for everyone. For some, it is a superpower. For others, it is an expensive trap. Let's find out which one it is for you. Let's start with the advantages. Why go through the paperwork? Advantage 1. Tax deferral and compounding. In many jurisdictions, the corporate tax rate is significantly lower than the highest personal income tax rate. If you make a profit as an individual, the taxman takes his cut immediately. But in a corporation, you can choose to leave the money inside the company. You pay the lower corporate tax, and you reinvest the difference. This is called tax deferral. Over 10 or 20 years, reinvesting that extra capital creates a compounding snowball that is mathematically impossible for an individual to beat. Advantage 2. Expense deductions. As an individual investor, your Bloomberg terminal, your data subscriptions, your high-end laptop, and your home office setup. These are often considered hobbies or personal expenses. But for a corporation, these are legitimate business expenses. You pay for them with pre-tax dollars, not post-tax dollars. This effectively gives you a 20 to 30% discount on all your operational costs. Advantage 3. Income splitting. This is crucial for family wealth. If you are the sole earner, you pay the highest tax bracket. But a corporation can have shareholders, your spouse, your children, or other family members. By distributing dividends to family members in lower tax brackets, the overall tax burden of the family decreases. It turns investing into a family business. Advantage 4. Limited liability. If you trade on margin or use leverage as an individual and things go wrong, creditors can come for your house and your car. A corporation is a separate legal person. If the corporation goes bankrupt, your personal assets outside the company are generally protected. It is a firewall between your trading risk and your family's livelihood. Now, let's look at the dark side. Why doesn't everyone do this? Disadvantage 1. Complexity and cost. A corporation is not free. You have incorporation fees. You have annual registration fees. And most importantly, you need an accountant. You cannot just download a tax report and file it yourself in 10 minutes. Corporate accounting is complex. If your portfolio is small, the accounting fees alone will eat up all your profits. If you are managing $10,000, a corporation is a burden. If you are managing $1,000, it is a necessity. The sweet spot is usually around $200,000 to $300,000 in capital. Disadvantage 2. The double taxation trap. Eventually, you want to spend the money, right? When you withdraw money from the corporation to your personal pocket, you get taxed again on dividends. If you don't plan this carefully, you might end up paying more total tax than if you just traded as an individual. The corporation works best as a vault for long-term accumulation, not as an ATM for daily spending. Disadvantage 3. Loss of capital gains, discounts. In some countries, like the US, Australia, or Korea, individuals get tax breaks for holding assets longer than a year. Corporations often do not get these specific discounts. They pay a flat rate on gains. You must calculate if the lower flat rate is actually better than the discounted individual rate. So, what is the verdict? Should you Inc. incorporate? Do it if you have a significant capital base, usually 6 figures. You don't need to spend the trading profits for daily living. You have a separate job. You want to pass wealth to the next generation. Don't do it if you are just starting with a small account. You need to withdraw your profits every month to pay rent. You hate paperwork and administrative headaches. Beyond the math, there is a psychological benefit to incorporation. When you trade through a corporate account, you feel different. It's not my money anymore. It's the company's capital. You become more disciplined. You don't make impulsive bets because you have a fiduciary duty to the corporation. You start holding board meetings, even if it's just with your spouse. You document decisions. It professionalizes your entire existence in the market. It forces you to act like an institution, not a retail gambler. Now we have the mindset, CEO, the plan, business plan, and the vehicle, the corporation. You have built a Ferrari. It is sleek, tax-efficient, and powerful. But a Ferrari sitting in the garage is useless. You need a destination. You need a reason to drive through the storms that are coming. Why are you doing all this? Is it just to see a bigger number on a screen? Money without a mission is just paper. Survival without a purpose is just existence. In the next episode, we will tackle the deepest question of all: why you must survive in the market. We will define your mission. Because when the market crashes 50%, tax benefits won't keep you in the game. Only your mission will. I'll see you in the next episode.